Hi, my name's Eric, and this is the Audible Local Ledger's reading of Barrons magazine for March 24th of 2025. The Audible Local Ledger is a reading service expressly for people who are blind or print disabled. We'll start with the first column that you come up against when you open the Barrons of this week, which is Up and Down Wall Street. Fed's Treasury buying will come in handy as foreigners sell, by Randall W. Forsyth. Everything keeps changing in this transitory life, according to the performance artist Laurie Anderson. The use of transitory was assumed to have been consigned to the dustbin of the history of the Federal Reserve's blunders after the Fed failed to recognize that post-COVID inflation was anything but passing. That's why Fed Chair Jerome Powell raised more than a few eyebrows this past week when he reverted to the T word to describe the impact of tariffs, announced and anticipated, on inflation. It can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us if it's transitory. And that can be the case in the case of tariff inflation, he said at his news conference on Wednesday following the Fed's policy meeting at which it held rates unchanged as expected. That would seem consistent with the advice to monetary policymakers proffered recently by Treasury Secretary Scott Bessent. I would hope that the failed Team Transitory could get back together and think that nothing is more transitory than tariffs. By that, one infers he meant the transitory impact on inflation, not continual flip-flops as to when and whether tariffs would be imposed. There was little ambiguity about Bessent's boss's thoughts on monetary policy. The Fed would be much capitalized, better off cutting rates capitalized, as U.S. tariffs start to ease, their way into the economy. Do the right thing, President Donald Trump posted on Truth Social. The Fed's newly updated summary of economic projections points to two cuts of 1/4 percentage point in the federal funds target rate, from the current range of 4.25% to 4.5% by year end. That's despite an increase in the projection for the core personal consumption expenditure index to 2.8% from 2.5% in the SEP that was published in December. The projection for 2025 gross domestic product growth was downgraded to 1.7% from 2.1% previously, which may reflect the largely technical contraction likely in the current quarter. The most recent GDP Now estimate from the Atlanta Fed is for negative 1.8% first quarter growth, largely due to a surge in imports, including gold bars, to beat anticipated tariffs. The Fed's projection for the unemployment rate ticked up to 4.4% from 4.3% previously, and the jobless rate was 4.1% in February. Less noticed was a slowing in the shrinkage of the Fed's balance sheet to redeeming $5 billion of Treasury securities a month from $35 billion previously. Powell pointed to complications related to the debt ceiling, which results in swings in the Treasury's cash balance that, in turn, affect bank reserves. Reduced redemptions will mean the Fed will be reinvesting $160 billion more in the Treasury market from April to December, according to John Riding and Conrad DeQuadros of Brain Capital. This will come in handy, given Uncle Sam's ongoing borrowing needs after foreign investors shed Treasury notes and bonds for the third straight month in February, according to Wells Fargo analysts Angelo Manalotos and William Gibbons. Foreigners, especially official investors such as central banks, have been reducing coupon holdings while shifting to short-term T-bills. Over the past year, foreign investors have bought $190 billion in T-bills, or nearly 31% of net T-bill issuance. Prior to coming to Washington, Bessent criticized former Treasury Secretary Janet Yellen for relying heavily on T-bills to fund the massive $2 trillion deficit, but so far he hasn't altered the Treasury's borrowing plans. If he announces in May a shift to more notes and bonds, the Fed's increased reinvestment would be welcome, given the selling of coupons by foreigners. Not to be overlooked is the administration's emphasis on the Treasury's 10-year yield, rather than the stock market as its key financial litmus test. Still, who knows what might change these days in this transitory life? You can't call them junk bonds anymore. Sub-investment grade corporate debt securities have come up in the world with higher credit quality to such an extent that their preferred moniker, high yield, scarcely fits. So, investors looking for richer returns have migrated to riskier environs, especially the trendiest one, private credit. That doesn't mean credit risk has disappeared, however. It's just become less visible in the private market, where credits don't trade and prices aren't posted on quote screens. Private credit describes what banks used to dominate, bespoke loans made typically to smaller growing businesses. High-yield bonds also have matured from the era of the 1980s, when Drexel Burnham Lambert pioneered new issues of sub-investment grade bonds to fund growing companies that previously were shut out by the incumbent Wall Street banks. It seems no coincidence that Drexel alums dominate the current credit powerhouses, such as Apollo Global Management, Blackstone, Jefferies Financial Group, and Ares Management, among others, that are leading the surge in private credit. The high-yield market has gotten safer as private credit markets have expanded the pool of risky borrowers, wrote Greg Obenshane, director of credits at Verdad, in a client note. Much of the riskiest borrowing from issuers whose credit would be rated CCC or B has moved to private credit and leveraged loans, he added in an interview. Private credit has grown to $2.5 trillion globally from just about $200 million in the early 2000s, according to the Bank for International Settlements quarterly review, which was published recently. Meanwhile, the Bloomberg High Yield Index totals about $1.4 trillion of debt, while the public leveraged loan market totals $1.3 trillion, according to Fitch data. In recent years, the high-yield bond market has increased glacially by 0.44% annually since 2015, compared with 11.4% compounded annually from 1986 to 2014, according to Martin Fridson, Chief Investment Officer of Lehman Livy & Fridson Advisors. The private market can provide more complicated financing that's more hand-carved than machine-made, said Greg Manchuk, portfolio manager of the Osterweiss Strategic Income Fund, in an interview. Banks did more of such highly leveraged transactions in the past, but have been restricted by regulatory curbs. Plus, some of them have a bitter taste from loans for transactions, such as Elon Musk's $44 billion buy of the former Twitter, now X. Only in the past month have the banks, led by Morgan Stanley, been able to sell the loans. Fridson said that BB credits, the top tier of speculative grade bonds, constitute 52.4% of the high-yield market, compared with 42.5% in 1997 through 2024. Triple C's and lower grade credits account for 13.5% of the sector versus 16.5% in 1997 to 2024. The shift of dodgier debtors from the public to the private markets may have sharply reduced those spreads, according to Edward Altman, professor emeritus of finance at the NYU Stern School of Business. Since 1986, the average high-yield spread was about 5.2 percentage points over risk-free treasuries, he said in an interview with Bloomberg last year. Except for a spike during the COVID crisis in 2020, the ICE B of A high-yield spread has trended under 3 percentage points. In recent months, the spread has gotten as tight as 2.6 percentage points, coincident with the peak in stock market. Speculative grade debt and stocks tend to trade in sync, given both reflect investors' assessments of corporate risks and returns, with bond prices falling as yields rise. Since the stock market headed into correction territory, the high-yield spread widened to 3.4 percentage points on March 13th, when the S&P 500 index closed at its low for 2025 so far. Coincident with the equity market's slight recovery in the past week, the spread had come in to 3.17 percentage points by Thursday. That's still a historically narrow yield premium for speculative grade credit. Partly, it reflects the relative scarcity of public high-yield bonds. Fritzen wrote in an email, which has made them trade expensively, meaning with higher prices and lower yields. That's even taking into consideration the change in the market's makeup toward BB-related and rated credit. At the opposite end of the credit spectrum, Fritzen finds that 5.7% of the market trades at distress levels, which he defines as a spread of a full 10 percentage points. The 1997 to 2024 average was 12.6%. While the siphoning of many weaker borrowers to private credit may have helped narrow spreads in the public high-yield market, that doesn't make spreads a less reliable economic indicator, Obensheim wrote. Investors demand more compensation when they see increased risk. Spreads still move in anticipation of economic weakness, not only among high yield but also investment-grade credits. That said, as some of the junkiest borrowers migrated to private credit, they recently found their way back to the public market via exchange-traded funds, such as SPDR, SSGA, IG Public and Private Credit, which has a ticker symbol of PRIV. For now, the ETF's portfolio consists mainly of public issues, with the biggest positions in agency, mortgage-backed, and treasury securities. Unlike private credit, the risk of what used to be called junk is out in the open. If the public markets start to buckle, the private parts also may be at risk, even if they aren't exposed. And that was written by Randall W. Forsyth. Next is the Streetwise column by Jack Huff. Managed futures are hot. You can manage without them. How's your crisis alpha? The managed futures industry is asking. It would like to pitch you on a fund that can beat other stuff, the alpha, when your stocks are falling, the crisis. Isn't that what bonds are for, you ask? Yes, but 60-40 investing is apparently for bumpkins. What's really needed is a go-anywhere, long, short, derivative, trend trading, quantitative model. What are the fees? The industry would rather you didn't ask for now, but we'll come to it. Last week, I wrote about some ways to hedge against a decline in the S&P 500 index. I disliked all of them to varying degrees, except for buying overseas stocks dutifully and bonds willingly, if not quite cheerfully. Some readers emailed to ask about things I left out, like managed futures and commodities, especially gold. Let me touch on those now with a disclaimer that I dislike most things that Wall Street recommends, whether because most things are bad or because I'm becoming old and cantankerous. It's difficult to tell the difference. Futures are contracts that can be used to bet on the direction of stock indexes, government bonds, commodities, and currencies. There are money managers called commodity trading advisors, or CTAs, who follow diversified futures strategies, and not just for commodities, despite their name. One common strategy is trend following, which involves using software and charts to bet on markets that are rising and against ones that are falling. This isn't new. Managed futures have been around for just over 75 years. What is new is the rising number of exchange-traded funds that offer easy access, and the promotion of those funds as tools that ordinary savers need. Just this month, BlackRock launched the iShares Managed Futures ETF, promising a unique source of return to diversify a portfolio. A one-pager shows managed futures making money through the dot-com crash that started in April of 2000, the 2007-2009 financial crisis, and other stock mishaps. Peak glory might have come from January through October of 2022 when inflation roared. Both stocks and bonds stumbled badly, and managed futures tacked on more than 20%. Around that time, IMGP DBI Managed Futures Strategy, which is the biggest ETF, topped $1 billion in assets. There are other ETF choices from Simplify, CraneShares, Mount Lucas, WisdomTree, and First Trust, plus many traditional mutual funds, totaling $349 billion in managed futures strategies. That's up from $10 billion in 1990. It should be more, the industry argues, but investors are turned off by what they see as complexity. How much do managed futures return? There are two ways I can answer that question. There's an index of popular strategies from Societe Generale called SGCTA that goes all the way back to 2000. Morningstar, just under a year ago, found that it had returned 4.8% a year versus 5.9% for global stocks and 3.9% for global bonds. That's impressive, even if global stocks haven't done nearly as well as U.S. stocks in recent decades, and if high managed futures fees, 1.5% to 2.2% on many funds, can erase the edge over bonds. So far this year, the index, which is down 2.1%, isn't providing much crisis alpha. But then, this isn't much of a crisis, with the S&P 500 ETF recently down 2.8% and the Schwab U.S. Aggregate Bond ETF up 2.9%. The other answer is, I don't know. Managed futures are a strategy more than an asset class. I've heard that these funds provide exposure to commodities and currencies, but that's like saying that betting on college basketball provides exposure to the sporting industry. What it really provides is exposure to betting skills or systems. Stocks are 4 centuries old, with around 1.25 centuries of decent price data. And there remains a lively debate over just what level of return is normal for them. We know less about managed futures, including what effect the rising popularity of trend following will have on trends. What we can confidently say is that returns for managed futures bear little resemblance to stock and bond returns. That makes them mathematically useful for diversification. But then, chicken poop bingo provides low return correlation to stocks and bonds too. I don't recommend it for long-term wealth building. The good news is that fees are probably headed lower. That IMGP fund uses a follow-the-trend followers approach to keep expenses down to 0.85%. The new iShares fund comes in even lower at 0.8%. It's ironic that death of 60-40 conversations ramped up late in 2022 after both stocks and bonds had gotten clobbered. In hindsight, the time for those talks was before 2022 when bonds were yielding near zero. If they go back there again, I'd give the nod to managed futures over chickens and bingo tables for a diversifier. For now, I think savers can do without them. Now, here's some crisis alpha. Gold is up 15% this year. The broader iShares S&P GSCI Commodity Indexed Trust is up 2.8%. So, how about commodities for a hedge? The problem is that commodities are stuff. And we have a measure of how the price of stuff and services behaves over time. It's called the rate of inflation, and the goal for investors is to beat it, not match it. History suggests that bonds beat inflation by a little, stocks beat it by a lot. For stuff, I don't know how to accurately predict which items will race ahead or fall behind the others in the near term, whether from shortages, industrial demand, or speculation. If I did, I'd have put this column on hold a year ago to launch the 3X Bullish Eggs Power Alpha Trend Trader ETF, ticker YOKE, and I'd be clucking now about the 133% run-up on the price of a large white dozen, instead of griping about my omelet expenditures. But at least some of the companies in my cheap stock index funds produce stuff, including gold and eggs, and others sell equipment for stuff production, and still others manufacture stuff into even more valuable stuff. I guess that makes me accidentally neutral, bordering on involuntarily bullish. That was written by Jack Huff. It's time for the review and preview for this week's Barrons, and this week's Barrons is dated March 25th of 2025. Top stock on down days is the headline. What's the most defensive stock in the S&P 500? Many investors think of defensive names such as AT&T and Verizon Communications, cigarette maker Altria, or Johnson & Johnson, which have resilient business models and solid above-market dividends. But it turns out the winner is options trading leader CBOE Global Markets. Using data from Barrons' parent Dow Jones, we looked at the top S&P 500 performers during the index's 10 worst days in the past 8 months, including March 10th, when the index fell 2.6%. CBOE shares rose 1.9% that day to $217.06, within 2% of its record high. CBOE rose in all 10 of the index's biggest down days since July. Number 2 is insurer Cigna, up 9 of those days. 6 stocks gained on 8 of those dates. American Water Works, Crown Castle, Centene, Hershey, Altria, and Verizon. Utilities, food, healthcare, and tobacco are traditionally defensive, with less economically sensitive earnings and above-average dividend yields. This year, these sectors are up, while the S&P 500 is down 3.6%. For CBOE, big down days often mean high options volume. The CBOE has the leading position in U.S. equity options, with a roughly 30% market share so far this year. KBW analyst Kyle Voigt wrote that based on options volume, the company's first quarter earnings could top the consensus estimate. Voigt rates the shares at market perform with a $216 target price. And that was written by Andrew Barry. Last week, from the review and preview section, in the markets last week, the OECD cut its growth forecast due to President Donald Trump's trade policies. The biggest victims, Canada and Mexico. Israeli airstrikes pounded Gaza, shattering the ceasefire. Oil and gold rose. Retail spending missed expectations. Stocks edged up on Monday and then fell on Tuesday, led by techs. The Federal Reserve held rates steady but was cautious in its outlook. Stocks were volatile ahead of big options expirations on Friday. On the week, the Dow Industrials rose 1.2%, the S&P 500 0.5%, and the Nasdaq Composite 0.17%. In companies, Berkshire Hathaway's Warren Buffett said he was adding to stakes in 5 Japanese trading houses. BYD revealed a fast-charging technology for electric vehicles, 5 minutes for 292 miles. Canada is reviewing its purchase of 88 Lockheed Martin F-35 jet fighters. And NVIDIA said it would work with General Motors on self-driving vehicles and with telecom companies on new 6G networks. In deals last week, the Financial Times reported that Alphabet is spinning off Taara, its laser-based internet business, to compete with SpaceX's Starlink. Alphabet also announced a $32 billion all-cash deal for Israeli cybersecurity startup Wiz. PepsiCo said it was buying prebiotic soda brand Poppi for $1.95 billion. QXO agreed to buy Beacon Roofing Supply for $11 billion, including debt. SoftBank is buying chip designer Ampere Computing for $6.5 billion. Buyout investor Bill Chisholm is buying the Boston Celtics for $6.1 billion, a U.S. sports team record. What about this week? From Review and Preview in Barrons Magazine for Monday, March 24th, S&P Global releases both its manufacturing and services purchasing managers indexes for March. Consensus estimates are for a 51.5 reading for the manufacturing PMI and a 50.9 reading for the services PMI. This would compare with 52.7 and 51, respectively, in February. On Tuesday, the 25th of March, the Conference Board releases its Consumer Confidence Index for March. Expectations are for a 94 reading. That's about 4 points fewer than previously. In February, the index registered its largest monthly decline since August of 2021. On Wednesday, March 26th, the Census Bureau releases the Durable Goods Report for February. The consensus call is for new orders of durable manufactured goods to decline 1% month over month to $283 billion. And then on Friday, March 28th, the Bureau of Economic Analysis releases the Personal Consumption Expenditures Price Index for February. Economists forecast a 2.5% year-over-year increase matching the January figure. The core PCE price index is expected to rise 2.7%, 0.1 of a percentage point more than previously. The numbers: 25% is the reduction in U.S. drug overdoses in the 12 months ended October 2024 compared to the prior year. $16 billion. Short seller profits on Tesla stock after its December 17th closing high. Shares lost $700 billion in value since then. 40. Record month-to-month percentage point equity allocation decline in a March B of A fund manager survey. And $22 billion. The net inflows to short-term Treasury funds between early January and March 14th. Which is the most in 2 years. Our next headline: 5 stocks to play Trump's industrial agenda. The changes now being wrought will lead to more factories and require more power, automation, and artificial intelligence to run them, by Al Rote. President Donald Trump's plan to upend decades of economic orthodoxy by bringing manufacturing home has economists, politicians, and investors reeling. But one thing is certain: making more in America will provide some serious momentum for industrial stocks. It's been a long time since the U.S. could be considered the dominant manufacturer in the world. Since 2001, when China joined the WTO, America's share of global manufacturing has dropped to 15% from 25%. Factories that made everything from wireless routers to chairs to t-shirts moved overseas as companies chased the lowest costs, regardless of location. The result was good for U.S. companies and shoppers, even if it was bad for factory workers. 5 million well-paying jobs disappeared, and it was tough for the country, which gradually forfeited its industrial edge. Now the Trump administration wants to bring it all back home. If it succeeds, gone will be the cheap clothes, TVs, and tchotchkes that shoppers compulsively buy, replaced by more expensive American-made goods. At least that's the goal, according to Vice President J.D. Vance. Being able to make things is good because it creates self-sufficiency as a nation, and it creates self-sufficiency in our people, he said in a speech in Michigan on March 14th. And more importantly, manufacturing jobs are good for our workers. Change is never easy, especially when it aims to remake an economy that's been the envy of the rest of the world. Today, much of the manufacturing expertise is located overseas. Chips in Taiwan, lithium-ion batteries in China, robots in Japan. The tool of choice, tariffs, will raise prices for U.S. shoppers. It will reduce consumption, and it will slow growth. The levies will also raise the cost of production for companies while reducing profit margins. Their chaotic implementation hasn't helped, and it threatens to bring the economy to a full stop if companies and shoppers become paralyzed by uncertainty. But investors shouldn't let a possible policy-induced recession distract them from the looming renaissance in U.S. manufacturing. The changes being wrought, changes that began during the first Trump administration and continued through the COVID pandemic, when companies experienced the downside of overly extended supply chains, will lead to more factories and require more power, automation, and artificial intelligence to run them. Ultimately, shares of companies that can bring this vision to life, such as Eaton, GE Vernova, and Rockwell Automation, will benefit. For 20 years, the thesis was that we can live in an asset-light world. And then all of a sudden it turns out that to make all these things, we need assets, says B of A securities analyst Andrew Obin. Industrials are going to be a very good place. Rebuilding America's industrial capacity won't come cheap. Construction spending for manufacturing facilities grew 20% in 2024 to $232 billion. That's up threefold from 2019. B of A expects high single-digit growth in 2025, driven by mega projects, those with budgets north of $1 billion. At the end of 2024, electrical equipment maker Eaton put the backlog of all such projects in North America at $1.9 trillion, up 33% from the year before. Ground was broken on just 15% of the projects, with a record number of starts expected in 2025. Companies that benefit from a building boom include Caterpillar, which makes construction equipment, and AECOM, which builds the plants. The factories of the future won't resemble those from the 1950s. It would cost too much. A U.S. manufacturing worker makes about $30 versus $3 an hour for a Mexican one. Nor are there Americans to fill all the jobs. McKinsey partner Liz Hempel said there's a shortage of 1.9 million manufacturing workers in the U.S., which is a gap that'll have to be filled by robots. Automation has to be part of the discussion, she says. All those factories will need power, too. U.S. electricity consumption was stagnant from 2000 to 2020, growing less than 0.3% a year on average. And then came electric vehicles, which shifted demand from the pump to the socket. Heat pumps that use electricity to manage home temperatures instead of burning heating oil or natural gas. And power-hungry AI data centers, which could consume 12% of U.S. electricity by 2028. Since 2020, electricity demand has grown almost 2% a year and should exceed that every year for the rest of the decade. That should be a boon to companies along the power line value chain, including Quanta Services, Prysmian, and Schneider Electric. In the short term, worries about the strength of the U.S. economy could overwhelm these tailwinds. After all, the industrial economy has struggled over the past 2 years, even with electrification, reshoring, and automation. The Institute for Supply Management Purchasing Managers Index was below 50, indicating shrinking activity for 26 consecutive months heading into 2025 before shifting to growth with 2 50-plus readings in January and February. Now tariffs and other policy uncertainties threaten to end the recovery just as it begins. It's still possible that a slowdown, if one occurs, will be short-lived. The manufacturing sector could prosper thanks to the shift in government focus, even as other parts of the economy struggle. Exchange-traded funds that track the industrial sector would be one way to bet on the American manufacturing renaissance, though none is perfect. The $1.6 billion iShares U.S. Industrials ETF, for instance, holds 191 stocks, but its two largest positions are Visa and MasterCard. The $3.1 billion First Trust RBA American Industrial Renaissance ETF holds 52 small and mid-cap stocks, including RBC Barrons and Mass Tech, but misses out on the larger stocks. Launched in 2024, the iShares U.S. Manufacturing ETF, with its large stakes in Deere and Honeywell International, as well as automakers such as General Motors, which are technically consumer discretionary companies, better reflects the theme. Unfortunately, it has less than $13 million in assets under management, which might be too small for most investors. Ultimately, the $20 billion Industrial Select Sector SPDR ETF, which offers market-weighted exposure to the group, or the $5.3 billion Vanguard Industrials ETF, which tracks industrial stocks in the MSCI US Index and includes everything from microcaps to large caps, could be the best bet. 5 individual stocks stand out for their exposure to America's manufacturing renaissance. In construction, there's CRH, which has turned itself into one of the largest building materials and construction companies in the world. It produces aggregates, stone, used to make concrete, as well as cement, asphalt, and other construction-related products, and it builds roads and infrastructure. Though it's based in Dublin, it gets 61% of its revenue from the U.S. Its vertically integrated business model enables the company to profit from the entire value chain, says Truist Securities analyst Keith Hughes. Hughes rates shares a buy and has a $120 price target for the stock. That's up 27% from a recent $94.65. His price target values CRH shares at about 12 times estimated earnings before interest, taxes, depreciation, and amortization, or EBITDA, which doesn't look expensive considering the company has grown that metric by about 10% a year on average for the past 5 years. Growth should continue due to a combination of industry strength and targeted acquisitions. CRH has completed more than 800 acquisitions. The automation of factories will benefit Rockwell Automation, a Milwaukee-based specialist in the automation and digital transformation of manufacturing processes. Rockwell's stock hasn't kept pace with the broader market over the past few years, as earnings growth stagnated from the manufacturing slowdown. But profits look set to accelerate again. The company beat earnings forecasts when it reported fiscal first quarter results in February, leading Oppenheimer analyst Noah Kaye to observe that demand is inflecting, quote unquote. Wall Street seems to agree. It's projecting average annual earnings growth of about 17% for the coming 2 years. Those numbers could be even better if demand for automation begins to outpace the broader economy again, writes Kaye, who has a $320 price target on Rockwell, up 24% from the recent $258.79. Like Rockwell, Ametek, A-M-E-T-E-K, which makes a broad range of electronic instruments and electromechanical devices for a host of industries, is also a beneficiary of automation. The company is expected to grow earnings of about 10% a year on average for the next few years, and with an added boost from improving U.S. manufacturing, growth could be faster than expected. That makes the stock worth a look, even at 25 times 2025 earnings estimates, a premium on the S&P 500 index's 21 times. Ametek is a good management team with broad exposure to capital spending trends, says Obin, who has a buy rating and a $225 price target on the stock, up 29% from recent levels. GE Vernova, which builds turbines, wind generators, and other products needed to produce and distribute electricity, should benefit as power demand grows. The stock has dropped 20% since January 27th, when China's DeepSeek caused all stocks related to the AI trade to tumble on concerns that the technology didn't have to be quite so power-hungry. The sell-off looks like an opportunity. Shares trade for about 27 times estimated 2026 earnings before EBITDA, more expensive than the typical industrial stocks in the S&P 500, which trade for closer to 15 times 2026 EBITDA. GE Vernova, however, is expected to grow its EBITDA by almost 50% between 2025 and 2026. That number for industrial companies in the S&P 500 is closer to 10%. B of A's Obin points out that before GE ran into serious trouble a few years ago, Wall Street valued its power assets at about $80 billion. Stock volatility and multiple aside, investors have bid Vernova back close to those levels. He sees more upside given rising demand, rating shares buy with a $485 price target for the stock, up 45% from a recent $333.87. Like GE Vernova, Eaton benefits directly from accelerating demand for electricity. But rather than making the turbines that turn natural gas into electricity, it makes the hardware and software that helps electricity move from a regional substation to a home, factory, or data center. Its shares have dropped 20% since peaking at $371 in January on those same DeepSeek fears. It looks like a dip to buy. At an analyst and investor day in March, Eaton said it plans to grow sales by 6 to 9% annually until 2030, while expanding profit margins by about 4 percentage points from almost 20% in 2024. That adds up to earnings growth of greater than 12% annually, with additional upside from mergers and acquisitions. After the event, KeyBank analyst Jeffrey Hammond upgraded Eaton stock to a buy from hold and established a $340 price target, up 15% from a recent $295.44. It pays to stick with solid businesses. Eaton shares have returned 19% a year for the past 10 years, 6 percentage points better than the S&P 500. It's one stock that doesn't need to be made great again. It's already there. Moving on to the cover story of this week's Barrons, dated March 24th of 2025. Single retirees face new challenges. How to cope. The population of seniors living alone is rising amid mounting concerns about their nest eggs, Social Security, and Medicaid. Here's how they're getting by Elizabeth O'Brien. Bill Kincaid and his wife had their retirement all planned out. In 2015, the retired physician downsized from St. Louis to Washington, D.C., where they enjoyed museums and concerts and other activities. But 2 years ago, Kincaid's wife, Marilyn, died at 76 following complications from chemotherapy. Kincaid found himself alone, forced to recalibrate his life without a partner. "We had each other covered," says Kincaid, who's now 78, "but stuff happens." Challenges are mounting for retirees as the government safety net is in flux and costs mount for health services and long-term care. It can be even tougher for single retirees, whether it's managing household finances, dealing with health issues, or warding off loneliness, a risk factor for physical and mental health. Solo retirees are now far more prevalent, and more are on the way. People aged 65 and older who lived alone headed 11% of all U.S. households in 2020. That's up from 9% in 2010, according to the U.S. Census Bureau. About half of women and 29% of men 65 and over are unpartnered, according to a Pew Research Center analysis of census data. Those figures may rise as more younger adults reach retirement without a partner or spouse. Roughly 38% of the population ages 25 to 54 was unpartnered in 2019. That's up from 29% in 1990, according to Pew. And 53% were married. That's down from 67% in 1990. Contributing to lower marriage rates are greater economic opportunities for women and less societal pressures to marry, social scientists say. Plenty of single seniors are doing fine, happy to be living on their own with enough savings and help from family or friends. It's a mistake to assume that partnered people always have the best outcomes, says Michelle Putnam, director of the Gerontology Institute at UMass Boston. But experts say the country is ill-equipped to handle the growing population of seniors, and the singles among them who may be the most vulnerable, needing more health services, long-term care, and financial resources. The country just doesn't have the resources to deal with the people who'll be coming down the road, Kincaid says. We don't have enough nursing homes to put people in as we age. The safety nets that have been in place for decades, Social Security, Medicare, and Medicaid, may now be facing cuts too. President Donald Trump has vowed to protect Social Security benefits, yet staff cuts, field office closings, and reduced phone service outlined by the Department of Government Efficiency could make it more difficult for people to access their earned benefits, and it may cause payment disruptions, say advocates and Democrats. Any Americans receiving Social Security benefits will continue to receive them, White House Press Secretary Caroline Leavitt told Barrons. The sole mission of DOGE is to identify waste, fraud, and abuse only. House Republicans advanced a bill in March that outlined $880 billion in likely cuts to Medicaid over the next 10 years. Jointly funded by the federal government and states, Medicaid provides health insurance for the poor and is the primary funder for long-term care in the U.S., paying 63% of costs for nursing home residents. Cuts may shift more of costs to states, which would have to make decisions on how to allocate limited resources. The recent sell-off in stocks hasn't helped. The S&P 500 index is down 7.6% from its peak on February 19th. Federal Reserve Chair Jerome Powell calmed the market's nerves Wednesday as the Fed indicated 2 rate cuts are still coming this year. But the market's bullish narrative is looking shakier, hitting retiree investment accounts. If there were ever a time for solo seniors to take stock of their finances, social networks, and healthcare plans, it's now. Here's how some singles are dealing with the complexities and building a successful retirement. Build your team. When Kincaid lost his wife, he knew he'd need the help of friends. Fortunately, he already had quite a few, thanks to a nonprofit called Village to Village Network. The couple joined their local group when they moved to Washington, and it's become a big part of Kincaid's life. We instantly had 150 acquaintances, some of whom became very good friends, says Kincaid, who's now a board president of the Village to Village Network. Members of the group provide companionship and volunteer for one another, offering pickups from hospitals, taking care of pets, and helping out with groceries or shopping. The idea more broadly is to create a team for support. Along with providing a social network, team members can include professionals who can help manage your finances and health. Designating a team captain may be helpful too. Elder law attorneys or specialists called aging life care professionals help clients navigate the services they need and refer them to other professionals if necessary. Attorney Eric Einhardt plays that role for clients. We like to say we have a pit crew for our clients. We wind up becoming the spoke in the wheel, says Einhardt, a partner at Russo Law Group in Garden City, New York, and vice president of the National Academy of Elder Law Attorneys Board of Directors. Fix your estate plan and healthcare directives. While all adults need basic estate and healthcare planning, it's especially important for single retirees. This includes appointing a healthcare proxy to make medical decisions if you're incapacitated, and a living will that outlines the interventions like breathing support that you might want or reject. Mary Johnson, a 73-year-old retiree in Central Virginia, says that while she's close to some neighbors and a cousin out of state, she didn't want to burden them with being her healthcare proxy. She engaged a geriatric care manager to serve in that capacity and asked friends and family to be conduits if needed. I'm the kind of planner who likes to have a blueprint, says Johnson, who's been divorced for nearly 30 years. Kincaid named his brother in St. Louis as his healthcare power of attorney and communicated his wishes for his care and eventual burial. His local friends know to contact his brother in an emergency. Professional fiduciaries can act as healthcare or financial power of attorney. The term can refer both to the document that names an agent and the person acting in that capacity. Different people can serve each role, and you can always change your mind and designate someone else as long as you retain mental capacity. Sometimes older adults try to circumvent the need for a financial power of attorney by adding a relative or another trusted person as a joint owner of their financial accounts. But that poses complications, says Craig Parker, Assistant General Counsel of Product at estate planning firm Trust and Will. No matter how much you trust that person, if they get divorced or sued, your assets may get tied up in the proceedings. The terminology and rules for advance directives vary by state. AARP maintains a list of advance directive forms by state on its website. People with serious chronic conditions or advanced frailty can also fill out a portable medical order, which some states call a POLST or MOLST. Put a copy of your healthcare directives on your refrigerator. Paramedics are trained to look there, says Stephen Barlam, president of the Aging Life Care Association. Don't lock your documents in a safe, since that can create headaches if you're incapacitated and no one has access. Daily money managers, another type of professional, also help older adults manage their finances. They provide support with bill paying and other routine tasks, and some act as a healthcare proxy or a financial power of attorney and representative payee for Medicare. Financial planning. Most people wind up alone toward the end of their lives. Financial planning should prepare for that reality. Couples must ensure that both members understand the family finances, so the surviving spouse isn't left in the lurch if the person who managed the money dies first. Widows and widowers must also contend with reduced household incomes. When one spouse dies, his or her Social Security payments stop. While surviving spouses might see a bump up in their own benefits, those households don't keep receiving 2 checks. Surviving spouses might find that their new tax filing status of single pushes them into higher income bracket for Medicare premiums, an additional financial hit. Even so, managing a portfolio for one doesn't look that different than for two. Either way, retirees should hold 1 to 2 years' worth of withdrawals in cash. Say you get $35,000 from Social Security a year, but you need $60,000 to meet living expenses. You'd put $25,000 to $50,000 in money market funds, high-yield savings accounts, or another cash equivalent. That way, if the market's down, you're not forced to make withdrawals on a declining balance, which is a surefire way to drain your portfolio quicker. Diane Brissy, a New York City retiree, has a couple of years' worth of expenses in cash. She topped off her short-term bucket by trimming some appreciated stock before the presidential election. It felt like the right thing to do, says Brissy, who's in her 70s. Consider using a set withdrawal rate and keep it steady. A good place to start is 4.7%, according to Bill Bengen, the retired financial planner who developed the original 4% rule, but has since bumped it up. This idea, if you're planning for a 30-year retirement, is to withdraw 4.7% from your portfolio each year, adjusted upward for inflation, assuming a standard portfolio of 55% stocks, 40% bonds, and 5% cash. Keeping withdrawals at that level offers a high likelihood that your money will last for 30 years. For a $1 million portfolio, you could withdraw $47,000 the first year and $48,410 the next year, assuming 3% inflation. The rule's customizable based on your circumstances. For example, people retiring in their 70s could safely withdraw more than someone with a longer retirement horizon. Bengen tested his withdrawal rate across a broad swath of market conditions and found that it holds in down markets. Still, for peace of mind, some retirees may prefer skipping the annual inflation adjustment following years when their portfolio has lost money. Bengen's rule applies regardless of portfolio size, but single women in particular may have a smaller nest egg than men or couples. Brissy, for example, worked her way up from being a bank teller in the 70s to making multi-million-dollar deals in institutional fixed income sales. I got 50% of the pay the guy next to me got, so I'm starting in the hole, she says. With a smaller cushion, solo retirees may have to be more mindful of their cash flow, says Tana Gildea, principal of financial advisory firm Homrich Berg in Atlanta. She likes the bucket approach, where you maintain multiple accounts for different purposes, such as near-term expenses, vacations, and health care. To help sort it all out, she names each of a client's accounts for their uses. Many advisors recommend a dedicated account for long-term care. Standalone long-term care insurance has become too expensive for most pre-retirees. A popular alternative, permanent life insurance with a long-term care rider, may be less attractive for singles who don't have an heir for their policy's death benefit. Long-term care can be extremely costly, and many retirees will eventually need it. 56% of people turning 65 today will develop a disability serious enough to require long-term care, according to a 2022 report from the U.S. Department of Health and Human Services. The report defined disability as long-term care insurance policies typically do: the inability to perform at least 2 activities of daily living, or the need for substantial supervision due to serious cognitive impairment. Families may decide that their loved one needs support at lower levels of disability, so the number of older adults who will require care is probably higher than the report suggests. The average duration of disability for women is 3.6 years, while the average for men is 2.5 years, the HHS study found. You can project the future cost of care in your area using Genworth's online tool. Multiply the annual amount by estimated years needed, and then put that money aside in a conservatively invested account. If that amount is out of reach, earmark whatever you can. Even having $25,000 set aside for future long-term care can give you some peace of mind, Gildea says. Dealing with isolation. Money matters tend to get the most attention in retirement planning, but the social component is just as key. Americans overall have become more isolated in the age of Facebook and other social media, and striking up friendships only got tougher after COVID disrupted casual meetups and groups. Still, it's important to reconnect and forge new friendships, using old techniques that still work. Jump back into an activity you enjoy and look for groups, whether it's a weekly bridge game, book club, dance class, or Bible study. Give friends in the group your contact information so they can check up on you if you miss a meeting. A formal retirement community is another option. Johnson's toured some in her area. Still healthy in her early 70s, she plans to move into one by age 80. In case she becomes incapacitated sooner, she's already lined up someone to care for her cat, Toby. Making a move may not be easy, but it only gets harder in a crisis, and your options might be more limited at the last minute, since many retirement communities have wait lists. Taking an action kills the fear and the worry, Gildea says. Breesy, a former Masters swimmer, is counting on friends and activities to sustain her as she faces the decades ahead. She enjoys yoga, working out at the gym, and auditing college classes in Italian and European history. She does her best to conserve savings, figuring she'll stay in good health for many more years even as the money dwindles. My doctor said I'll live a long time, and I told him I can't afford it, she says. And with that, we've come to the end of our reading of Barrons magazine for March 24th of 2025. This is your reader, Eric, saying be well, be safe, look after each other, and remember our veterans, especially those we've lost recently. Bye for now.